About a minute away to get the FOMC readings. We're gonna see markets go crazy today. Da, da, Let there be light. Whabam, boys and girls, some boys and girls. Let's cancel this. All right. It is gonna be an ugly day. I have a feeling.
10
But I could be
seconds.
wrong. 10 seconds indeed. Let's get that quick. It's out.
So seeing the CBO 30-year debt, Fed rate no change rate remains unchanged at 5.5% as expected. CBO 30-year debt and deficit forecasts are lower due to discretionary spending limits passed by Congress, a stronger GDP growth due to increased immigration.
Ooh.
So CBO projects its debt held by public's fiscal year. Fed officials, median view of the Fed funds rate end of 2025 at 3.9%, previous 3.6%. Risk to employment and inflation goals are moving into better balance. Remain strongly committed to getting inflation back to 2%. Fed projections show 9 of 19 officials see the policy rate above 4.6%, median forecast for 2024. Fed projections imply 75 basis points of rate cuts this year from the current level, additional 75 basis points next year as well. Median view of the Fed funds rate in the longer run, 2.6%, up from the 2.5% previously. Inflation has cooled over the past year, but remains elevated, and projections show higher long-term policy rate projections at 2.6% versus 2.5% in December. Projections show one fewer rate cut in 2025 than previously forecast. Fed policymakers see the end of 2024 PCE inflation at 2.4%, unchanged from the December projection. Core seen at 2.6%, which is up from the 2.4% seen previously. Economic outlook is uncertain. Central bank highly attentive to inflation risks. Projections show only one official seeing more than 325 basis point rate cuts for this year. Policymakers upgrade the 2024 GDP growth forecast to 2.1% from 1.4%, seeing unemployment rates at 4% versus 4.1%
We still
in
think
the
we're getting
December
3
projection.
cuts.
In describing state of the job
This is good
market,
for the
amidst
markets.
January's characterization of jobs gains having moderated. Economic activity expanding at a solid pace, job gains remaining strong, unemployment rates low.
They're gonna leave it until the next rate cut.
The Fed also maintained their current pace of balance sheet drawdown. Following this, upside move in the S&P 500, downside in the dollar
S&P
as
likes
well.
this a lot.
So again, US interest rates remaining unchanged at 5.5% as expected. A slight upward revision to the inflation forecast, as well as the longer run interest rate forecast as well in this dot plot. So we have posted that out on the feed for anybody interested.
Insanity. This is good for markets. This is good for markets. I am quite surprised. But we see the cuts here. We're going potentially a little bit lower, but most of the Fed members are thinking that we're still going to get those 3 cuts right here. Wow. Market likes that originally. I mean, it'll be interesting to see what he says, you know, because they're definitely going to question him on that. So that is coming up next. Let's have a look at something. And X. Let's try to get some information here. Insane. Still 1% chance for a gut. Nick. GDP is going to be higher than expected, and PCE was revised up to 2.6% in December. Look at that real. Come on. Here we go. Federal funds rate is still 4.6. Last time was changes here. Real GDP comes in hotter. It's still the same, so there's no change. That's interesting. That's really good for markets. we could potentially see a pump market. Like we could see markets going in higher from here. Wow. You're gonna try to push it out. He's not gonna give a projection, but 6, 3.9, 3.1. So the longer, so as rates are coming in later, that has declined. So higher for longer still remains, which I'm surprised the market has sort of like taken, you know? And it's like it's okay. But I mean like that depends that's a change that depends on I mean on data, right? Core PCE inflation 2.4, 2.2, and they're
Traders
expecting the
pricing
same.
additional Fed easing in 2024.
Wow. Insane. Gonna go down to what? That hurts. I'm gonna be hurting on those shorts. Today's a good day. Today's a good day. Rifter's showing strength. I wonder when he speaks, what's gonna be the thing that actually changes it. 24 minutes away from his um market seems to like it. Market seems to like it. Dang. Insanity. Hello, and welcome to another episode of Scotch and Stocks, chilling in his house, trying to make some money, hopefully. Yeah, well, I need to make a couple of tea. A sec. Oh, Fed members thinks we're gonna cut. Yeah.
US yields falling after the Fed's 2024 median forecast held steady.
It's a top flop the other day. Just wow. Market's turning around a little bit on those news. Okay, market's coming back to balance. And it's like the original one was like, look, it's not bad, right? They're gonna cut still this year, but are they gonna continue to cut next year? Big question goes down to are they gonna wow. This is good. I mean we broke. Here we're breaking a little bit of the resistance. That should be good. Oof, oof, oof. Oh, wow, wow. Market turned around. Seems to like the news so much. We're back. We're coming back down. Was it searching the buying? Was it searching the buying the cues? It wasn't that. I mean, like we're still higher than the. Interesting. That was the time to short. Is he gonna come in like hawkish? You know, that is a big question. Some nice. Wow, wow, wow. Get back. Still crazy. The GDP goes up, but that means productivity goes up. That means that they don't have to come down much, which is a good thing. Now, the S&P and the Nasdaq sort of giving away a little bit of their gain. You got that? Yeah. We are trying to get it. Let's have a look. Let us look. Like we don't see unemployment rate tick up. So theoretically, this goes out for a soft landing. What they're thinking, it's like it's gotta be right. Like we gotta be at the point where they celebrate. The, ooh, we're gonna go higher. I mean, this means we go higher until May, right? It's gotta be. PC inflation is gonna come to 2%. It might take a little bit longer. I mean, 2024, 2025, but that is what is expected of core. In theory, happens the same, and then we plot that this was last time. Like the mean. I think we're back here. We are at that range. Wow. Additionally. Oh. Changed. So no cut. No cut in May. 64% we get a cut in June. 48% we get a cut in July. Now it's like 31.6, depending on how the data comes out. So that means that he potentially comes out today saying, hey, nothing to worry about. Everything's fine. We've achieved a soft landing. Everybody go celebrate and buy stocks because it's the way. Just insanity all throughout. INT got it right. What's there? What's there? Let's look at it. Let's analyze some of the currencies. Like we're getting more cuts, so currency's going up. Crypto's up, dollar's down, oil is down. Oil is down? Why is oil down on this news? Oh, because longer run. Maybe that's right. Well, then we got one app. This guy up.
Amazon is developing a new AI tool for online shopping, according to The Insider.
AI. Am I buying Bix here? I want to buy Bix. I want to buy Bix. Sorry about that. Oh. Interesting. We're giving it away. So we got the hype. We got the initial hype. This is the moment of short. This is the moment of short. We're going to reject it. Feels like it. Make sure you have your longs ready because if I say it's going to be short, it's time to short, it's time to buy. Never pay attention to me. I have no idea what I'm talking. Hey. We're giving it away.
So regarding the market reaction to this FOMC decision and the SEP, we saw US equities jump to session highs this afternoon as the Federal Reserve held interest rates steady and signaled that the central bankers are expecting 75 basis points of cuts this year. So the Fed's so-called dot plot was in focus, as investors had speculated that a recent uptick in economic activity and inflation could lead to fewer cuts this year. So in the end, the Fed signaled the same number of rate cuts the market had already priced in. So it does seem that this lack of deviation from the prior expectation is what caused the strength in US indexes, weakness in the dollar and government bond yields as well.
People are getting out, man. I don't think people trust it. Do we trust it? You know, it's like the whole market was expecting it to come down strong. Is he gonna come in a little bit hawkish? We got up. Markets like it. Question is, do we double down? The VIX. The VIX didn't like that at all. This tells us, like, as long as he doesn't say anything crazy. Let's have a look at what.
This is bad for him. That's we will have Jerome Powell's rug pull, rug tug, or I don't know, hand out of big tendies because he goes dovish. Who knows? There are a lot of very varied expectations. I want to be crystal clear about my expectations.
At
I've memorialized
2:30
them.
p.m.
Not only in
Eastern
various
Time, we
videos
get
we've
the
covered, but also on
FOMC
EHAC.com.
press conference
My
with Chair
expectations are that we
Powell.
are going to see the summary of economic projections move up. We are, that is, we're going to see the dots, the good old dot move up. This is mostly because we have started to see signs of, sadly, a little bit more persistent and sticky inflation and wage price growth. Both of those things together. Summer goes in for surgery at 1:45 today. So in really bad. So that's bearish. I don't like that. For the juiciness. So again, take a screenshot of my predictions. Hold me accountable if I'm wrong. It's okay. But I think I'm gonna be surprised if it's different from this. If we get hotter than 4.8, I'm gonna be a little nervous on that bottom left there. Hotter than 4.8 would be bad. I think if we get 4.7 or 4.8, the market trades sideways or maybe goes up a little. If we get 4.6 or less, the market goes down. The market goes up. If
According
4.6
to
or less,
Echoes, the French
we should
government
rally.
deficit
We should get
estimated around
4.6 or less.
5.6% in
If we get
2023.
anything over 4.8, like 4.9 or higher,
And
it's
US
gonna hurt.
Treasury yields now higher
That's my
after the
take.
Fed.
That's what I'm
10-year
going
yields
into this
last
with.
at
I'm sticking to it.
4.297%.
So that's my take. And yeah, all right. Here. No way. They kept it at 4.6. That's great. That's bullish. I mean, that's bullish. 4.6. They did go 3.9. That's what Bank of America and I said. They did bump GDP a lot. That's bullish. They really went bullish on this one. That's not bad. Stronger economy, and they're sticking with the 3 cuts. Let's go ahead. Let me put this really quickly in the PDF reader. I'm really surprised by that. We did not get any change, so now it's going to come down to a timing aspect. So take a look right here, and we are looking at 4.6, surprised by that. 3.9, that's a match to what I said. I said 3.3. They ended up going 3.1. So I missed on the left one. I got the middle one right, and I missed on this one. So they went lower on both of those. Oh, look at this. No way. I did not think they were going to do that. There's no way. I thought that was no way. I thought for sure that was going to end up being a what's it called? A 2.5. I thought they would wait for the future to do that. Honestly, I'm surprised by that. That is a little surprising. The thought there for sure was that we were going to get 2.5 stable, but that's surprising. They're kind of implying that maybe that longer run rate is indeed going to be higher, but still penciling in those 3 cuts for this year. So a little surprised by that. End up seeing some kind of movement here at where the
5-6%.
59 p.m. Price is going up. Lifetime access forever. Trade alerts, course member live streams, you name it. Email staff@meetkevin.com if you have questions. Okay, I had to do that. I'm sorry. Okay, this is 4.6. So initially we look at this and go, oh, that's good for interest rate sensitives. Buy interest rate sensitives.
But it's
that was
not.
an idea going into this. The rug tug that came from the unexpected place was this.
And long term. The long term messes us up, man. That sucks. Let us see what he has to say.
change. This longer term change changes the slope of interest rates going down from interest rates. Well, I would call it the big six and chips. Big six and chips, they win from these numbers right here. Absolutely. Interest rate sensitive, so I'll call them IS. IS lose here. Okay, that's very interesting. Wow, okay, what else are the suits saying? So, looking at suits, 6 minutes to Powell. Market
At
moves fading.
2:30 p.m. Eastern Time, we get the FOMC press conference with Chair Jerome Powell. We have put the live stream out on the feed for all those interested.
The user may better visualize the footprint of option activity within the marketplace by comparing bubble sizes for calls or puts, indicating option volume, option open interest, or implied volatility.
Check that out. See. Just wow. That is gonna hurt. Went up a little bit higher. Dang. Interest rate. Fuck. Sucks. Surprised that oil is not going up on Disney. Sounds taking a beating, eh? It's an interesting one to play too. Gonna give us a pulling.
Fading now to go higher in that range, that 4.6 to 4.87. That's bizarre. Let's go look at the dots. JPOW comes out in 2 minutes.
Shortly expecting
But
the beginning
that's
of the
weird.
FOMC press conference.
I guess the bulk of them are here. You've got 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 at 4.6. 9 at 4.6. You've got 1 at 4.4. You've got 1, 2, 3, 4, 5. 5 at 4 point. It's hard to tell where that is. Like 8.5. 5 at 4.85, and that might end up being 6.5, something like that. And then you've got a few above it. 2 at what is that? 5.125. And then 2 at 5.375 probably. Yeah, that's probably right. So that actually might be 4.675. So if somebody can run the math on that, that'd be really cool. I might do it while JPOW comes out. JPOW is about to come out, so we'll see what he says. Somebody says, why don't you stream on YouTube? I am on YouTube. You got to go to the Meet Kevin Live channel. Meet Kevin Live. That's where we do the these streams now. Come join us. We go live every morning at 5:25 in the morning for Market Open live stream. Yeah, they're not talking about the average. They're talking about the most common value. I think so. It's weird. Waiting for JPOW to walk in now. I'm going to look. If I do, I'm going to just try to do some quick math on that. Because I think that's a little fugazi.
Fugazi.
Okay, so if we have... Okay, let's listen in here for a moment.
About 0.4% for the Dow, a little more than that for the NASDAQ, and
NYMEX diesel April futures settled at $2.69 a gallon. NYMEX gasoline April futures settled at $2.73 a gallon. NYMEX WTI crude April futures settle at $81.68 a barrel. That's down $1.79 or 2.14%. And seeing NYMEX natural gas April futures settle.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February,
Be interesting
and
to
that
see what we get
excluding
for
the volatile
PCE
food and energy
this
categories,
month.
core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress, and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term.
You're going to punt
To
it.
conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can
Wow.
to achieve our
You're gonna
maximum
punt it.
employment and price stability goals. Thank you.
Still may.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming as I pointed out in my opening remarks. We did mark up our growth forecast, and so have many other forecasters. So the economy is performing well, and the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down, and so.
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe. And so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE.
This is a good question on that owner's equivalent and how it's calculated. And it may not happen. There's no guarantee of it. Let's see what Powell says here.
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Yeah, okay. He's pouring cold water on those higher inflation reports. It's bullish. This is a dovish Powell.
Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, you know, if we ease too much or too soon, we could see inflation come back, and if we ease too late, we could do unnecessary harm to employment and you know, people's working lives. And so, we do see the risks as two-sided, so it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year, adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need? Or by June, is there enough data for you? Just give us a sense of your thinking.
We'll stay here longer if we need to.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
Yep.
But, just a question of, is there even enough data for you to be able to?
We'll take, things can happen during an intermeeting period if you look back, unexpected things. So I wouldn't.
It's a couple of
dismiss
months,
anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Okay.
Hi, Chris Regaber, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question? I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. I mean, my instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero.
There's the risk.
In some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident, or last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end
Of course it
number
doesn't.
reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless,
Yeah,
we're
but
looking
you
for
pay
data
attention
that
to month to month.
confirm the kind of low readings that we had last year, and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%.
Oh, they're trying to lap last year. That's what they're trying to do. That's not good. That means like waiting until September for cuts.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Anne that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year, with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
Yeah, I have no open shorts. Y'all gotta chill.
No, I mean, we saw, you saw last year, very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Yeah, I just closed a short right after we had Enphase go up. I shorted Enphase. I made $6,500, closed it. I've got no open positions. So I just made $6,500 on this conference. Thank you.
Financial conditions since the fall is
of course, members know that.
what you're trying to achieve on the inflation mandate.
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand.
There you go, on screen. Take a screenshot.
From the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate. Things like that are really demand. There are also supply side things.
The whole market is pumping. Crypto back up.
We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward, since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and you can.
It is a good day.
And I think many advise.
It is a good day.
Did see.
It was like $100 on my shorts, but that's
adjustment
okay.
problems there.
I'll sell them tomorrow.
But again,
Hopefully,
you
we don't
wanna-
like explode
You got to
higher.
be careful about dismissing the parts of the data that you don't like. So, then February wasn't as high, but it was higher. So the question is, what are we going to see? You know, we tend to see a little bit stronger. This is in the data. A little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that it's
slowly
continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned.
This is funny because like
that's what you still see. We've got 9 months.
Most of the returns that I'm getting on today is not because of the market
We've
overall.
had
It's
2
just one
months of kind of
stock.
bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we just don't. We can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately.
They're going to wait, honestly, I think October, November, December, if they're trying to lap year over year.
Mr. Chairman, Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from
Not my job.
So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who, in our system of government, have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cutting rates? Thank you.
We're very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents. And so you respect thoughtful dissents very much. It's like, you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed just to understand that book. So I treat dissents with real respect as well.
Market data connection loss.
Simon Rabinovich with The Economist. Can you hear me?
Yes.
Okay,
Market
great.
data connection reestablished.
Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to tick up. The forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing, essentially, is and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and
thanks, Jeff, for that shout out.
The aggregate reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress. And that can cause you to prematurely stop the process to avoid the stress. And then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So, so that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this this decision made first, and then we can, when the time is right, come back to the other issues.
Hi, Victoria Guida with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserves situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops near at zero?
Well, I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask also about the balance sheet. Will you said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower you can get farther, but that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point, ultimately, where you stop allowing the balance sheet to run off, but then, from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand. And then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile. And we don't want to, again, find ourselves in a situation where there aren't reserves. We have to turn around and, buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. But we would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. No. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases.
What's ARM at today?
At still high levels, but back down to levels that are more sustainable over time.
ARM pump. God damn it.
Thank you, Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of a CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. You know, it has applications in wholesale finance, in the payment system. And so to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. You know, I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that, so Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8, so now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. There's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE, coming down by 0.1% every month, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data on the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
All right, let's get into a summary. Quick reminder, I'm going to
Man, this guy's so good. I don't understand how he does it.
Trading during this meeting. We're also
Even
going to
GPT.
talk full summary on
Holy
the Fed
shit.
here. Remember that prices on the Stocks and Psych group go up this Friday
Fucking
at
Kevin
11:59
GPT.
p.m. If you have questions, email us at staff@meetkevin.com. Team's ready to reply to you. We'd love to have you course member. We've been doing course member live streams for 6 years now, and we're going to keep doing them. So join us there for trade strategies. This morning we set up a trade strategy. We talked about how there might be an opportunity to trade going into the release, but then get out potentially before Powell speaks, because everything changes when Powell speaks all the time. And so that's what I did over here on Enphase. And so I'll talk about that in just a moment. So let's get into the summary. Okay, summary, here we go. Wow, the Federal Reserve just tugged us in a location we were not expecting to get tugged in. And I made a trade during this press conference. Well, actually, right before the press conference. Was it profitable? I went into this Fed day with no positions. Did have positions over the last few days. I send out all my alerts to Stocks and Psych course members. Well, during the, right after the release of the information, I ended up going short Enphase after it ran all the way up to this 113 line, went short right about here, rode it until we started moving back up. Obviously, I wish I closed it at rock bottom. I would have been up 10K, but I closed it up about $6,500. I have that trade confirmation right here, so you could see the option that was traded, and you can kind of match that up with the prices, and you can see it. So anyway, let's get into the summary. If you want all those alerts, be a part of Stocks and Psych. Price goes up on Friday. You get lifetime access to all trades forever and course member live streams. You don't even have to watch the course lectures if you don't want to. Although there's good content in there anyway. Now, let's talk about the Fed. Wow. Okay, first we got to look at the statement, because the different rugging that we got here was a little bit of a surprise. I certainly was surprised. Bank of America nailed this segment right here. Bank of America nailed the steady 4.6 and the 4.9. Now keep in mind, that is steady 4.6 on a median basis. On an average basis, this number went up. If you jump on over to the dot plot right here, and you see what's happening right here, we calculated out roughly what we think actually that median projection or the average projection went to. The average projection went to about 4.83. My prediction was we were going to go to 4.8. We're right on the average, wrong on what's on the form. The form calls for median. Oh well. So it is interesting because you did see a move up, but even though you saw a move up, it wasn't enough to change the middle number, the median number. So that was a surprise. That's surprise number one. Surprise number two was right here. We suggested this could happen, and it happened. It happened. But I didn't think it was going to happen this meeting, because I thought we were going to revise this up, and we weren't going to touch this yet, but eventually we would. Well, we touched it. We went to 2.6 from 2.5 for the longer-term rate. What does that mean? Well, it makes this very simple, folks.
I'll watch the video tomorrow. All right. Thanks so much for watching, everybody.